Something unusual happened in the precious metals market this week, and most people completely missed it. On the surface, everything looked normal. Prices fell hard, then bounced back even harder. Headlines talked about a recovery, analysts called it a healthy correction, and traders moved on to the next chart. But beneath the surface, in places most investors never look, the system behaved in a way it simply shouldn't. And once you notice it, it becomes impossible to unsee. On Monday, February 2, 2026, gold and silver experienced what appeared to be a sharp but ordinary sell-off. Gold dropped aggressively, silver collapsed even faster, and financial media wasted no time labeling it a routine liquidation. Risk-off sentiment, profit-taking, technical pressure, the usual explanations were rolled out. But then something happened that doesn't fit the normal script. Within just 48 hours, nearly $6 trillion flowed back into precious metals. Gold surged more than 15% from its lows, adding roughly $4.7 trillion to its total market capitalization. Silver didn't just recover, it exploded, rising more than 26% and injecting nearly $1 trillion back into its valuation. By Wednesday morning, gold was once again trading above $5,000 per ounce, a level most analysts had considered psychologically extreme just weeks earlier. Moves like that are not normal. Historically, when precious metals experience forced liquidations, the recovery is slow and cautious. It takes weeks or even months for confidence to return. Buyers wait, sellers remain active, and volatility lingers. But this time, the reversal was immediate, aggressive, and tightly concentrated. Prices didn't stabilize and grind higher. They snapped back violently. Analysts tried to explain it away using familiar language. Oversold conditions, short covering, bargain hunting by institutions. None of those explanations fully accounted for what was actually happening, because the most important developments weren't occurring on trading screens. While paper markets celebrated the rebound, the physical market was telling a completely different story. In China, millions of retail investors attempted to buy gold at the same time. Chinese banks offer digital gold accumulation programs that allow citizens to purchase physical gold through mobile apps. These systems handle enormous volumes every day and have functioned reliably for years. But when gold prices dipped on Monday, demand surged so violently that multiple banking applications crashed. Users were locked out of accounts, transactions failed, error messages appeared across platforms, and customer service systems were overwhelmed. This wasn't a glitch at one institution. It was a system-wide failure driven by overwhelming physical demand. That detail matters, because it reveals behavior. When prices dropped, real buyers didn't hesitate. They didn't wait for confirmation. They didn't speculate. They tried to secure physical metal immediately. And they weren't interested in paper exposure or synthetic products. They wanted delivery. They wanted possession. And the system simply couldn't keep up. At the same time, in Dubai, physical silver premiums quietly surged. Dealers reported buyers paying as much as 15% above spot prices just to secure immediate delivery. That kind of premium doesn't appear in a healthy, well-supplied market. It appears when buyers fear future unavailability more than they fear paying extra today. Premiums like that signal scarcity, not speculation. Meanwhile, in the United States, the most important data point of the week went largely unnoticed. On Monday alone, nearly 2 million ounces of silver were withdrawn from COMEX registered vaults. Not transferred, not reclassified, withdrawn entirely. Asahi reported 35,000 ounces removed. Brinks showed over 1.1 million ounces leaving the registered category. HSBC documented 400,000 ounces withdrawn. JP Morgan reported more than 1.2 million ounces exiting its vaults. In a single day, nearly 6% of all registered silver inventory vanished from the system. That is not how markets behave during sell-offs. Normally, when prices fall sharply, physical metal flows back into exchange vaults as holders sell into weakness. Inventories rise. Liquidity improves. But this time, the opposite happened. Paper prices fell, and physical metal disappeared. Total registered silver dropped to just over 103 million ounces. Total COMEX silver across all categories fell to approximately 243 million ounces. That is an extraordinarily low level relative to the size of the paper market built on top of it. Across the Pacific, the same pattern emerged. The Shanghai Futures Exchange reported net outflows of more than 26,000 kilograms of silver in a single session. The Shanghai Gold Exchange showed over 11,000 kilograms of gold withdrawn within 7 days. These were not accounting movements. This was physical metal leaving the system. At the same time, silver prices in Shanghai traded as high as $104 per ounce, while Western spot markets quoted around $91. That $13 premium, nearly 14%, persisted instead of closing. Buyers weren't arbitraging the difference. They were paying up to secure metal locally. Open interest data added another critical layer. Silver open interest in Shanghai collapsed, signaling that speculative activity had been wiped out. Leveraged positions were gone. Hot money had exited. What remained were commercial users and physical buyers. Gold open interest showed a similar washout. This wasn't accumulation through futures contracts. It was extraction through delivery. While traders focused on charts and volatility metrics, vault data was flashing warnings. The paper market said everything was fine. The physical market said something was breaking. Then, on February 4th, something else happened, far from trading floors and vaults. In Washington, representatives from over 50 nations convened for what was officially called the Critical Minerals Ministerial. It didn't dominate headlines. There were no dramatic press conferences. But the attendee list told the real story. The Vice President, the Secretary of State, senior Treasury officials, defense officials, economic advisors. This wasn't symbolic. It was strategic. One major global power was notably absent, China. The stated goal of the meeting was to diversify critical mineral supply chains and reduce dependence on non-market economies. But the real objective was clear. Build a parallel resource system that operates outside Beijing's control. For decades, China had positioned itself as the dominant processor and refiner of essential minerals. Rare earths, lithium, cobalt, graphite, nickel. Western nations allowed this because it was cheaper and more efficient. But efficiency created dependence. When China introduced export controls on key materials in late 2024, the vulnerability became obvious. Semiconductor manufacturers scrambled. Defense contractors panicked. Supply chains stalled. What had once been an economic advantage became a geopolitical weapon. Days before the ministerial meeting, the United States unveiled Project Vault, a strategic stockpile initiative funded with $12 billion. Modeled after the Strategic Petroleum Reserve, the program would purchase critical minerals to ensure domestic supply security. Lithium, cobalt, rare earths, graphite, nickel, and for the first time in U.S. history, silver. On January 15, 2026, the U.S. Geological Survey officially classified silver as a critical mineral, citing its irreplaceable role in electronics, solar energy, medical devices, and advanced defense systems. That classification changed everything. Silver was no longer just a precious metal. It became a strategic asset. And governments do not rely on free markets to secure strategic assets. They intervene. They stockpile. They position early. While governments planned for shortages, other stress signals appeared. In Japan, a routine government bond auction quietly failed to inspire confidence. Demand weakened. Yields rose to levels not seen since 1999. With national debt exceeding 260% of GDP, Japan's entire economic model depends on low interest rates. Rising yields threaten the foundation of that system. A scheduled 30-year bond auction loomed, representing a critical test of long-term confidence. When Japanese yields rise, global markets feel it. Capital flows reverse. Carry trades unwind. Leveraged positions liquidate. Everything sells initially, including gold and silver. That dynamic explained Monday's sell-off. Not weakness in metals, but forced liquidation driven by currency and bond market stress. The recovery that followed wasn't speculative enthusiasm. It was safe haven demand reasserting itself. Geopolitical tensions remained unresolved. Middle East risks lingered. Any escalation would trigger the same sequence: panic selling, followed by rapid flows into tangible assets. Meanwhile, cryptocurrency markets told a different story when measured properly. Bitcoin traded below $76,000, but priced in gold, it had declined significantly from its peak. Gold and silver had outperformed not against fiat, but against digital alternatives designed to replace them. All of these developments converged at once. Paper markets stabilized. Physical markets tightened. Governments built stockpiles. Vault inventories drained. Banking apps crashed under gold demand. Open interest collapsed. Shorts were trapped in markets with disappearing supply. This was not a recovery. It was a repricing occurring while the physical foundation of the system was being quietly dismantled. Systems don't announce their failure. They fracture silently. A vault withdrawal here. A banking outage there. A stockpile announcement buried in a press release. Individually, these events seem manageable. Together, they form a pattern. The real question isn't whether prices will go up or down tomorrow. The question is simpler. When paper pricing and physical reality can no longer coexist, which one gives way? The evidence suggests the answer is already being written, 1 ounce at a time. If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.